The most powerful financial institution on earth just pulled a lever that could rewrite the future of the U.S. economy. Not in months, not in a year, but for years to come. Right now, Wall Street is frozen. Millions of Americans are whispering the same question. What does this mean for my money? And for the first time in a long time, economists are openly split. Here's the truth nobody's telling you. This moment could be remembered as the start of a massive boom, or the quiet opening chapter of America's next financial storm. Once you see what's hidden behind today's announcement, you will never look at the economy the same way again. Stay with me, because the next few minutes might shock you. The Fed decision and its hidden message. Just moments ago, the Federal Reserve announced it has cut interest rates again, bringing the federal funds rate to a 3-year low of 3.50% to 3.75%. This marks the third straight rate cut in 2025. Third straight warning. Most investors expected this. The markets had priced it in weeks ago. Yet, the reaction was anything but uniform. Some indexes exploded higher, others pulled back in disbelief. This is confusion at the highest level. And confusion in the Fed signals something big is brewing behind the curtain. Because this wasn't just about what the Fed said, it was about what they didn't say and what they subtly hinted might come next. The division inside the Fed, a very rare signal. At this meeting, the vote wasn't unanimous. 3 Fed members dissented. Think about that. 3. Some wanted a larger emergency cut. Others wanted no cuts at all. This is not minor disagreement. It's a policy crisis in real time. Ask yourself, would a strong, healthy economy create this kind of internal chaos? Absolutely not. This split reveals fear, uncertainty, and tension. And history tells us when the Fed is divided, markets are vulnerable. Wall Street's reaction, look closely. Minutes after the announcement, the Dow Jones jumped nearly 500 points. The S&P 500 approached record highs. The Nasdaq ticked higher. On the surface, it looks bullish, but here's the twist. The rally wasn't led by banks or financials, the traditional beneficiaries of rate cuts. It was driven by speculative tech stocks, the last to rise, first to fall sectors. That's not confidence. That's panic disguised as optimism. When markets rally on shaky foundations, they rarely stay up for long. Powell's silent warning. Fed Chair Jerome Powell didn't just announce the cut. He added a line that sent chills through traders. Future cuts are not guaranteed. Imagine hearing, "We're putting out a fire today, but we may not have water tomorrow." Investors fear uncertainty more than numbers. Powell's words implied the Fed might be losing control of the narrative. And when the Fed loses control, markets begin to write their own story, a story that rarely ends quietly. Why the Fed cut? The real reason why cut, when inflation is still above the 2% target, employment is stable, and growth is slowing. Because the Fed is trapped in a policy vice. Too much inflation to cut aggressively, too little growth to keep rates high, confidence too fragile to remain neutral. This is exactly the zone where mistakes ripple globally. Historically, rate cuts under uncertainty precede major economic events. 2000. Tech bubble. Early cuts misread as good news. 2008, financial crisis, pre-crash liquidity injections. 2020, pandemic crash, stimulus disguised underlying stress. And now, we may be entering a new cycle with echoes of the past. Historical parallels. Let's dig deeper. 1933. Franklin Roosevelt's Executive Order 6102 forced Americans to turn in gold. Silver tripled in 24 months due to scarcity, not sudden demand. 1971. Nixon ended the Bretton Woods system. Gold and silver exploded. Silver rose from 6.70 to nearly 48 by 1980, a 37x increase from prior levels in inflation-adjusted terms. To date, 2011, Lehman Brothers collapsed. Silver quintupled in 3 years from $9 to $49.83. Notice the pattern. Early stress, followed by rapid spikes. Today, we're seeing the first signs of a similar structural tension. Inflation, still sticky dollar under pressure. Stock market rally driven by speculative sectors. Divided Fed. The calm could be temporary. Silver, gold, and commodity signals. Here's where things get even more telling. Gold has been climbing steadily, now around $2,050 per ounce. Commodity shortages and industrial demand are accelerating. Consider China. In 2025, it shipped around 660 tons of silver in a single month, enough to fill roughly 22 double-decker buses. Why? Analysts suggest London vaults are running low. Industrial demand for silver is skyrocketing. Solar panels. Each GW needs 0.1 million ounces of silver electric vehicles. 1-2 ounces per vehicle, 5G infrastructure, and AI data centers, new tech driving demand, mining production. or 813 million ounces annually. Industrial demand, over 1 billion ounces. Deficit, now ordered 95 million ounces in 2025 alone. Physical shortages and paper market leverage, 21 ratio, suggest a system on the edge of collapse if delivery defaults occur. The musical chairs. Analogy. Think of the economy like a game of musical chairs. Stage 1, everyone's dancing, everything seems fine. Stage 2, chairs start disappearing quietly, unnoticed. Stage 3, music stops, panic begins. Stage 4, fight for the last chair. We appear to be entering stage 3 right now. Markets rally on hope, not strength. Confidence is fragile. One wrong move and the scramble begins. What this means for 2026. The Fed hinted at only one more cut in 2026, if any. One cut, that's it. When the Fed runs out of tools, markets run out of luck. The real shock isn't the Fed cut itself. It is what it implies about next year. Markets may be pricing in too much optimism. Reality may arrive with explosive volatility. How this hits you directly. This is not abstract. It touches your wallet. Mortgage rates may drop slightly, but banks could tighten lending. Savings accounts earn less. Bond yields fluctuate unpredictably. Tech valuations soaring, but extreme risk. Gold and commodities may rise, but inflation and currency shifts create uncertainty. The public sees good news. Smart money sees fragility. Market warning signs to watch. Yield curve erratic with some inversions. Job market softening subtly. Speculative tech sectors rising faster than fundamentals. Inflation above 2% target. Sticky bank lending unusually cautious. Fed division policy uncertainty. These signs together indicate the system is on edge, even if headline numbers look stable. Final cliffhanger. Ask yourself, if the Fed is divided, if markets are cheering too fast, if cuts are almost done, then the optimism you see may not be optimism at all. It may be denial. And denial always precedes a major reality check. What you need to do. The Fed didn't save the economy. They bought time. Stay alert, not emotional track labor data, not just headlines. Expect volatility, not certainty. Watch inflation, bond yields, tech valuations, and Fed communications. This is not fear-mongering. This is history repeating itself. If you want part 2, where we break down recession triggers, safe haven strategies, exact trade setups and signals, comment yes below. Because this story is far from over, it's just getting louder.